Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 3. This is Section A4. This is a remembering and understanding topic. Identify and recall basic concepts and principles associated with fiduciary fund financial statements. And that would be things like the required funds, the financial statements, and the financial statement components. And we're going to be doing that SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to the full versions of these YouTube videos. Now, to be honest, in today's YouTube video, we're doing 5 questions, and the member version also only has 5 questions. Normally, the member version has an additional 5 questions, and so it has a total of 10 questions. But today's topic is a little bit smaller, a little bit more straightforward, so I felt that 5 questions was enough for YouTube and for members. But again, remember, if you like this, most of the other videos have a full 10-question version of it as a member version in our member forum. So make sure you check out becoming a SuperfastCPA Pro member to get access to the full versions of these videos. Now, with all that said, let's dive straight into the questions. Okay, here we are at question 1. Which required fiduciary fund financial statement reports information using the following format? Assets plus deferred outflows, less liabilities, less deferred inflows. So that is some kind of equation that's used in some kind of fund financial statement. Is it the fund financial balance sheet? Is it the statement of fiduciary net position? Is it the statement of net position? Or is it the statement of changes in fiduciary net position? So which one of these, again, is going to use this specific format? They're calculating their report using this format. If you know, that's great. If you have no idea what this is even talking about, that's okay. We are using these questions to learn the basics about fiduciary fund financial statements. So let's dive into the explanation for this one. All right, here we are at the answer B, the statement of fiduciary net position. So that's the statement that is going to be using this equation. So let's walk through this. The statement of fiduciary net position, so it's not just statement of net position, it's statement of fiduciary net position, is the fiduciary fund equivalent of a balance sheet. It includes assets, deferred outflows, liabilities, and deferred inflows, with the difference reported as net position. All fiduciary funds, so that's custodial, pension/OPEB, and we'll talk about that in one of the questions, private purpose trust, and investment trust, which, by the way, those are the 4 funds that are fiduciary funds. So again, custodial, pension, private purpose trust, and investment trust. They are required to present this statement along with the statement of changes in fiduciary net position. So the 2 required statements for fiduciary funds are statement of fiduciary net position and statement of changes in fiduciary net position. Fiduciary funds do not use fund balance terminology that belongs to governmental funds and do not prepare a statement of cash flows like the proprietary funds do. So we learned some of the basics about fiduciary fund statements in this question. Now let's go to the next question. All right, here we are at question 2. And something I always like to point out when it's an option is you want to read the last sentence of a question first. This is a very good habit to be in, especially on test day, because you have no idea what you're going to be seeing in the questions. You don't know what it's going to be about, so you read the last sentence first. Very frequently, that will give you context or an idea of what the question is talking about so that you know what to be looking for throughout the question. It's basically a way to kind of quickly understand what you're dealing with in each question. So let's do that here. Which fund should the state use? So imagine we were doing the BAR exam on test day. We read that, and we know that we're immediately dealing with funds, so we're immediately dealing with something to do with governmental accounting. That's a really great hint, so now let's go through this. The state government collects sales taxes from businesses and then remits the amounts directly to local cities. The state does not set how the money is spent, does not monitor the program, and has no financial obligation beyond collecting and passing along the money. So what fund are they going to use? Is it the general fund? Is it the special revenue fund? Is it a custodial fund? Or is it a debt service fund? If you know, that's great. If you have no idea what the fiduciary funds are or how to decide which one is which, that's okay. We're going to use this question and this explanation to learn. So let's dive into the explanation. All right, here we are at the answer C, the custodial fund. So let's learn about the custodial fund. This one is kind of like the most common one I've seen so far anyway. So the custodial fund hopefully is one that will be easy for you to remember. A custodial fund is used when a government collects and disperses resources on behalf of others, and that's kind of the key word there, on behalf, without having administrative or direct financial involvement. The key phrases are for the benefit of, or on behalf of, or for another government, whatever. A lot of times that's pointing towards fiduciary and especially custodial fund. Here, the state is acting as a cash conduit, simply passing sales taxes through to the cities. So they collect the sales taxes, but then they're just passing it directly through to the cities. If the government had responsibility for monitoring or administering the funds, so if they had more responsibility for it, it could fall under another fund type, such as maybe a special revenue fund, which is not a fiduciary fund. A debt service fund would only apply if the government itself had a legal obligation to service the debt. The general fund is for general operations and not appropriate for conduit transactions. So again, if the government is receiving money and holding it, but they're not really in charge of it, they don't decide how the money is used, and they don't have any obligation for it, they're just holding it until they're told what to do with it, then it is a custodial fund. They're just holding it. They're just custodians for it. Whereas if they were in charge of it, or if it was for something very specific, it might be a special revenue fund or a debt service fund. But we learned some basics about the custodial fund in this question. Now let's go to the next question. All right, here we are at question 3. Again, we're going to read the last sentence first. In which fund should the city report these resources? Let's go up to the top. The City of Orange holds refundable water and sewer customer deposits in a separate, legally established trust for former customers. By ordinance, the assets are dedicated to the claimants and cannot be used for city programs, and the assets are legally protected from the city's creditors. The city, as trustee, invests the funds, pays verified claims, and after the statutory dormancy period, remits a sheet, and by the way, we'll talk a little bit more about that, what that means, a sheet or unclaimed property to the state as required. In which fund should the city report these resources? So again, they get these customer deposits, they are legally have the trust for these, and these can't be used for other city programs, they can't be taken by the creditors, and the city is in charge of investing these and paying the claims and things like that. So again, is this going to be a general fund, a special revenue fund, a custodial fund, or a private purpose trust fund? We just learned about the custodial fund, so does this sound like that? Maybe, maybe not. So think about this, and when you're ready to come back, we'll look at the answer and learn a little bit more. All right, here we are at the answer D, the private purpose trust fund. So in this case, they're going to be using that instead of the custodial fund, but we're going to talk about how you can tell the difference. This is a private purpose trust fund because the city is holding resources in a qualifying trust or equivalent arrangement for the benefit of specific individuals, such as former customers, and the assets are both dedicated to beneficiaries and protected from the city's creditors. Now, we had a word in there that honestly I had never seen before I started studying for the CPA exam. I had no idea what a sheet meant. I don't even know if I'm 100% saying that correct. So what is a sheet property? It is unclaimed property, something like dormant deposits, uncashed checks, that a government holds for potential owners and after a legal dormancy period must remit to the state. Under GASB 84, which by the way, you probably don't really need to know that specifically, but under GASB, a sheet or unclaimed property can be reported in either a private purpose trust fund or a custodial fund depending on the facts. So it would be a private purpose trust fund if it was a bona fide trust / it had an equivalent arrangement, which it does in this question. So it has to be a trust that is specifically for something like, they're specifically holding this to be remitted to customers and to pay claims and things like that. Whereas, as we learned in question 2, a custodial fund is when the government is simply safeguarding and remitting under statute without a qualifying trust. They're just holding it until they're told what to do with it. They're not really responsible for it, they're just holding it. Whereas with a private purpose trust fund, it usually a lot of the time does deal with a sheet property, but it is specifically where they have a trust that is for using those funds for some specific reason rather than just holding it. Special revenue funds are for resources restricted to the government's own programs, so not money that they're going to be giving to somebody or using for somebody. The general fund is for general operations, as we've learned. Neither is appropriate for fiduciary resources held for others. So again, a lot of times, kind of as a general rule, probably if you see something that has to do with a sheet property, you probably can assume it's a private purpose trust fund, but pay attention to the wording. If they're just holding it and they have no responsibility for it and they're not really doing anything other than just giving it when the time comes, it might be a custodial fund. But if they have a specific trust for it and they're going to use it to pay claims and things like that, then it might be a private purpose trust fund. So we learned a little bit more in that question. Now let's go to the next question. All right, here we are at question 4. How should the county report these investments in its financial statements? Let's go to the top. County X establishes an investment pool that includes its own excess cash plus contributions from several school districts in the area. County X manages the pool and reports investment income back to all participants. How should the county report these investments in its financial statements? So again, how are they going to report this? Are they going to report the whole pool in the county's general fund, since it is the pool administrator? Are they going to report the school district share in an investment trust fund, while the county's own portion is reported in its normal operating funds? Is it going to report the entire pool in a custodial fund because the county is holding money for others? or is it going to report only note disclosures for the school's district's portion? No separate fund is required. Now think about this. If you have any guess or idea, then give it a good try. But if not, that's okay. We're going to look at the explanation in just a moment here. All right, here we are. The answer is B. They would report the school district's share in an investment trust fund, and they would account for their own portion in their normal operating funds. So let's go through this. An investment trust fund is used when a government sponsors an investment arrangement that serves other governments in addition to itself. The outside participants' share of the pooled investments must be reported in the investment trust fund. So again, this is another fiduciary fund, the investment trust fund. Sponsoring government's own deposits, however, remain in the funds they originated from, such as the general fund or the special revenue fund. This treatment reflects the fiduciary responsibility of the county to manage resources belonging to others, while still keeping its own financial resources visible in its operating funds, because fiduciary funds are not reported on the government-wide financial statements. That's something that if you didn't know, that would be why, they need to still report it in their own operating funds so that it's still visible. A custodial fund would be used only for collections and remittances without investment activity. Reporting everything in the general fund or in note disclosures alone would fail to recognize the fiduciary accountability involved. So we learned about the investment trust fund, fiduciary fund in this question. Now let's go to the next question. Okay, here we are at question 5. What amount should the city report as its net pension liability or NPL, and where should it appear? Let's go to the top. A city operates a defined benefit pension plan for its police department. At year end, actuaries calculate the total pension liability at $300 million. The plan's fiduciary net position, based on the fair value of the investments held in the pension trust fund, is $240 million. What amount should the city report as its net pension liability, and where should it report it? So think about this. If you have any guess or want to give it a try, that's great. If you don't know how pension trust funds work and things like that, that's fine. That's what we're learning in this video. So pause the video if you want, and when you're ready, come back. We'll look at the answer together. Okay, here we are. The answer is A, $60 million, and it would be reported in the government-wide financial statements under governmental activities. So a little bit different than what we've seen before, but we still need to learn about this. The net pension liability equals the total pension liability minus the fiduciary net position. In this case, that would be $300 million less $240 million equaling $60 million. The net pension liability is reported in the government-wide financial statements under governmental or business type activities depending on the employees covered. The pension trust fund itself reports the resources it holds, such as contributions, investments, benefit payments, but does not show the government's net liability. The general fund records only routine employer contributions as expenditures, not the entire liability. And this is important because this presentation separates the government's fiduciary role in managing plan assets from its obligation to employees for future pension benefits. So we're learning that they have to have this separation in the presentation. We learned how to calculate the net pension liability, and we learned where the fiduciary net position comes from. It comes from the pensions trust fund. And so you use that amount from the pension trust fund to calculate the net position or net pension liability, and you put that in the government-wide financial statements. Again, it's under the governmental activities. Now, with that, we've learned quite a bit about the different fiduciary funds and some basic concepts for them. Now, before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material in your review course, you will notice the things that keep popping up. You've seen 2 or 3 or maybe even 4 questions trying to teach you how custodial funds work, or when you would use a custodial fund, or even a private purpose trust fund. Whatever the case is, you notice these things throughout the questions, and so you take a moment and you pull them out and write them in your own words as pillar topics, the most important things you learned from the questions. And as you're doing this each day, you are building your own personal repository of the most important things you need to know for the exam, the pillar topics, so that you are ready for the exam when you get to it. So let's go ahead and look at the pillar topics for this video. Okay, here we are at the pillar topics. Let's just dive straight in. First off, what are the required fiduciary statements? Fiduciary funds must present a statement of fiduciary net position, and remember that was assets plus deferred outflows, less liabilities, less deferred inflows, and a statement of changes in fiduciary net position. They do not prepare a statement of cash flows or use fund balance terminology. So we learned the basic statements that are required there. Now let's talk about the 4 different kinds of funds. The custodial funds. Custodial funds are used when a government collects and remits money for or on behalf of others without administrative responsibility or financial obligation, essentially acting as a cash conduit. Now, private purpose trust funds, these are for resources held in trust for individuals, private organizations, or other governments. A sheet property, which again is kind of like unclaimed property, like uncashed checks, dormant deposits, or forgotten accounts, is a classic example as long as there is a bona fide trust for it. Like it has to be specifically for this kind of thing. They can't just be holding it, but they don't have really any responsibility for it. So again, think of that difference between the custodial funds and the private purpose trust funds. Now let's talk about investment trust funds. Investment trust funds account for the external share of investment pools when a government manages investments for itself and other governments. The host government's own deposits remain in its originating funds so that people can see it and so that it shows up. And then finally, the pension and OPEB trust funds. We talked about this the least. Pension and other employee benefit, which by the way, that's what that stands for, trust funds, hold pension plan resources, account for deferred compensation plans outside proprietary funds, and measure the net pension liability as the total pension liability less the fiduciary net position. The net pension liability is reported at the government-wide level, not inside the trust fund. So again, that one was the one that we learned the least about, but pension trust funds and other employee benefit trust funds, they are for employee compensation, they're for pension plans, and you're going to figure out the net pension liability for those and report it in the government-wide financial statements. Now with that, that is the end of the YouTube version of this video, where we only went over 5 questions and the pillar topics. Those are the basic concepts that you would want to know for the fiduciary funds. Remember, normally SuperfastCPA Pro members get access to a full 10-question version of the video. Now again, to be honest, in today's video, we did 5 questions for YouTube, and we're going to do the same 5 questions for members because it's kind of a smaller topic, pretty straightforward, so I didn't feel like it was necessary to do 10 questions for members. But normally, the SuperfastCPA Pro members get access to the full 10-question versions of these videos. So if you liked this and you like our other videos, make sure to check out becoming a SuperfastCPA Pro member. And the easiest way to learn about that is to first go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after that, that will give you a great path to learning about and becoming a SuperfastCPA Pro member. So check out the webinar, check out becoming a Pro member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next one.